Okay. We are going to finish up Chapter 9. This is the second part. The first part of Chapter 9, we talked about accounts receivable and the uncollectible amounts of accounts receivable, which we call the allowance for doubtful accounts. Here, we're going to be talking about a different type of receivable. We're going to be talking about a note receivable. Now, up to this point, we've talked about notes payable before, so we would abbreviate this NR. We've talked about notes payable. That's when we take out a loan, when we get a loan from a bank, right? And this is a liability because we owe it back. A notes receivable is when we loan money to someone else. Perhaps it's to a subsidiary or some other company that's working with us that needs a little cash. Maybe sometimes it's to officers, although that's frowned upon more and more these days. But this is an asset, meaning we've loaned the money and we're expecting to get paid back. But remember, with a note payable, we pay back the note plus interest. A notes receivable, we're going to get paid back the amount that we loan out plus interest when we get it back. For the purposes of what we're looking at here, we're going to talk about notes receivable that are 1 year or less for the most part, and that will make it a current asset, anything that's 1 year or less. So in practicality, that would be like 3 or 6 or 9 months. We try and keep it sort of in quarters. Sometimes we'll have a very short one, like 14 days. And if we have these sort of shorter terms, we need to understand how to read the quote for the loan. In other words, how do we say the loan? So the loan would be a 6-month loan. Here's an example of $1,000 at 10% interest. Now, this number here is always at an annual rate. Even though this is a 6-month loan, what we need to do is this 10% isn't 10% for 6 months. It's 10% for a year, and then we have to adjust it because it's less than 1 year. So what do I mean by that? Well, if we take the annual rate, $1,000 times 10% would equal $100, but it's not for a full year, it's for 6 months. So traditionally what we do is, even though the months are different lengths, we don't worry too much about there being some months that are 30 days or some months that are 31 days. So we just do times. In this case, it would be 6 out of 12. If it was 3 months, it'd be 3 out of 12, or 9 months, 9 out of 12. But those would be quarters. That'd be 1 quarter, 1/2, and 3/4. So here, 100 times essentially 1/2, right? That would reduce the 1/2 is, we're saying it's $50. That would be the total interest on this loan when we paid it back. Just as a side note, just like we don't get into whether a month has 30 days or 31 days or 28 days, here the convention is if we quote a loan in days, because it's 14 days or 21 days or something like that, we do it out of 360 days, not 365. So when we look at here, let's just issue a normal notes receivable and see what it looks like. So let's say we've got a 6-month note and we're issuing it on April 1st. So we issue the notes receivable on April 1st, and we're going to have an asset now, a notes receivable, and we're going to give cash. So it'd be a credit to cash. I will point out sometimes what actually happens is sometimes a customer buys something and so they have an AR, but they can't pay it off in time. Remember our terms of trade, maybe they're 210 net 30, maybe they can't pay it off in 30 days. So what they do is they say, can you give me an extension? And what we say is, as the company, yes, we can turn your AR into a note, but that means you're going to have to pay interest on it. So they say, that's fine. I couldn't pay it off in 30 days, but I can pay it off in 90 days, even if I have to pay some interest. So rather than being cash, sometimes when we convert an accounts receivable into a note, it'd be NR from an AR. It'd be the same thing It's still cash as an asset, as an AR and as an asset, but we wind up with a notes receivable. So what happens 6 months later when they pay us back? Well, we're going to get not only the $1,000, but we're going to get the $50 as well, right? So we're going to get $1,000.50 for both the repayment of the note plus the $50, and they no longer owe us. So we don't tear it up, but we get rid of the notes receivable. They no longer owe us that. Plus, what else did we got? We got some interest, and we're going to record that as interest revenue. So these are both credits. Okay, well, that's sort of the basics of it. Let's look at one twist. So this one is from April 1st to October 1st, right? 6 months. Well, we could also have a 6 months that crosses the end of the year, couldn't we? In other words, it goes from October 1st, but now let's add a year into it, 22, to April 1st, 23. Well, when it crosses the end of the year, there's some special things we need to consider. Let's say it's this same loan where there's $50 worth of interest. Well, when we get paid back, we're still going to get paid back the $1,000.50. The thing we have to remember is, just like we talked about in the last video, we recognize interest when it's earned. Well, didn't we lend some of the money? Didn't we lend the money? Wasn't it available to the person who borrowed it? Partly in 22 and partly in 23. So when we look at this $50, was that $50 all earned in 23? No, it was partly earned in 22 and partly earned in 23. So we're going to have to do something to recognize some of the interest revenue here and some of the interest revenue here. And that's the proper way to recognize revenue, is even if we don't get paid the cash, we need to recognize that we had loaned out the money for part of 22 and part of 23. Therefore, the interest revenue will be earned in both of those years. So let's take another example, but let's make the numbers work out a little bit differently. Let's take a loan that is 6 months, still 6 months, but now it's going to be a $1,200 loan, 10%, and let's say it goes from November 1st, 22, and gets repaid May 1st, 23. Well, the first thing we want to do is we want to calculate what's the total amount of interest that's going to happen here. Well, it's $1,200 times 10%. Now, remember, this is the annual rate, so that if it was a loan for a year, the interest would be $120. But it's only 6 months, so we're going to multiply that 6 out of 12, or 1/2. So it's going to be $60 of total interest. Now, the reason why I did this is because the loan is for 6 months. So really what I've done is I've said that it is $10 a month. Just made my math a little easier to worry about. Right? So it's going to be 6 months, and we're going to, the amount of interest that we earn each month is $10. So let's take a look. When we issue the note, when we actually loan the money, we have a notes receivable of $1,200. We give the cash of $1,200. Now, what happens is at the end of the year, we have to recognize the amount of revenue, the amount of interest revenue that we've earned. Well, how many months have happened between November 1st and December 31st? Well, all of November and all of December, so 2 months. So 2 months, and if it's $10 a month, we've earned $20 worth of interest. So interest revenue of $20, and they haven't paid us that, right? Even though we've earned it, they're not going to pay us that $20 until they pay off the note. So what do we need to do? We need to create something else. an interest receivable. In other words, we earned it, but we haven't received it yet. Interest receivable. When we go ahead and reach to May 1st, well, May 1st is 4 months. I know it says, once you start dealing with the notes, you'll get a little better at it. But remember, it's all of January, it's all of February, all of March, all of April, right? So it's 4 full months, and we get paid on the 1st. So again, what's going to happen? Well, we're going to get cash for the $1,200 plus the $60 of total interest. So it's going to be $1,260, right? Part of that's going to come from the note receivable. They're repaying the note. So we're going to cancel the note because they've repaid it. Now, it's 4 months between January 1st and May 1st, right? That's 4 months. And we say we earn interest at a rate of $10 a month. So I'll have interest revenue of 40. Well, these don't quite add up yet, right? We've got a debit of $1,260 and we've got 2 credits of $1,240. Well, where's this other 20 going to come from? Well, from here. Remember, at the end of last year, we recognized $20 of revenue, but we said it's not been paid yet. Well, here it is being paid, so we need to go ahead and not only cancel out this notes receivable, we need to cancel out this interest receivable. And now our debits and our credits equal, right? $1,260 in cash, $1,200 from the notes receivable, 40. So if we looked at the 2 years, in 22 and 23, we earned $20 of it here in 22 and $40 of it here for a total of 60, right? So we got paid the full amount of interest in cash. We just recognized the revenue as split between 2 different years. And that's what this ends up doing. Okay, I did mention that this second part was going to be a little bit more concise. So there we go. We kind of did it in half the time as the other video. And that's all for Chapter 9. I'll put up some information about the upcoming test here in just a little bit.